Now talk about Havells. It has come out with its earnings. The stock is down more than 2.7% in trade. So if you look at it, the consumer electrical good maker has reported a decline of over 12% in its consolidated net profit. That's come in at 305 crore rupees. We've got the top boss, Mr. Anil Rai Gupta, now joining us live right here on the market. Mr. Gupta, of course, the chairman and managing director of Havells India. Good morning, Mr. Gupta. The last time we spoke to you was when you were, announcing your new factory in Rajasthan and taking advantage of the Atmanirbhar movement with air conditioners. But looking at the earnings, the first question I think the markets will want to know, okay, the festive demand has been encouraging. Post that, where is demand at? We're in the midst of a, Omicron wave 2.
Well, I guess, as you rightly said, that the post the second wave and the festive demand was generally a good growth period. And that was continued, over the last couple of years. So overall, 2 year CAGR has been encouraging. But due to the rise in COVID cases during the second half of December, we saw some tapering down. January also saw some lockdowns in certain parts of the country. So there was a little bit of tapering of demand in the second half of December and the first half of January. And that's a little bit of more of, I would not really say that tertiary demand is still down because construction is still open. But there is a little bit of slowdown in terms of pickup by the trade. Hopefully now with the third wave being mild, we should be expecting normalized growth coming back in second half of February, March. That's what we're expecting.
Mr. Gupta, it's not just for you, it's across corporate India. Rising inflation, rising input costs that is squeezing out margins. We've seen some companies that have been able to pass on the higher cost to consumers. Some have not been able to. Can you share with us what your trajectory is and is likely to be when it comes to margins?
Well, as far as RM cost is concerned, I've always mentioned that it's been an unprecedented rise in raw material cost over the last 1 year or so. And hence, in certain product categories, some of them we have been able to pass on, like switchgears, lighting, cables and wires. And consumer durables is the festive or the seasonal demand is about to come in the coming time. And last couple of years have been a tepid growth for the consumer durables because of the season not hitting, or at least the COVID waves hitting during the season time. So we are expecting the cost pass on to happen sometime in the next couple of quarters, and hence the margins should be coming to normalized levels over a period of time. We do expect that this growth in raw material prices would taper down or at least stabilize over the next couple of quarters.
Right. Mr. Gupta, consumer durables and electricals, most companies have already taken a considerable price hike in the past few quarters. Wanted to understand how much more of a price hike can you really take without hurting your volumes and demand?
Yeah, this has been, a global inflationary trend over the last 1 year or so. And yes, it should affect the demand as well. But however, there are some positive tailwinds as well. So construction industry continues to do better post the COVID waves. The industrial and infrastructure segment has started showing good response. So while there could be some slowness in the overall tertiary demand from the consumer side, but at least the project side and the industrial side is kicking in. So I think overall should be a good mix. But yes, definitely inflation has been unprecedented.
Sure. Mr. Gupta, Lloyds has seen a decline in growth this particular quarter. What can we expect in Q4 since the summer season is around the corner? And whether or not you are seeing early demand trends actually look up?
As far as Lloyd is concerned, it's I think if you look at the 2 year CAGR, it's very healthy. It's over 25%, and so that is an indication that the last year base was a high base due to many factors. As far as seasonal demand is concerned, we are definitely expecting a very good summer. this time, given the fact that COVID had hit both in 2020 and 21 during the peak season time. So we are expecting not only a pent-up demand, but a good demand coming in the summer season. The initial trends are still a bit slow, as I said. Second half of December, January, because of the third wave, things have been slow, but we are expecting things to start coming back to normal levels in February and March.
As well as washing machines, they've been the new additions to the consumer durable side. So give us a sense as to how the initial trade channel reaction has been.
Well, I guess I would say that the trade channel response has been extremely positive, both in refrigerators and washing machines. Washing machines, the new in-house production also kicks in now. So that should also, increase the possibility of adding more models and range in the coming times. However, it will take its own time to build up a certain volume, which will, give a balance to the entire portfolio of Lloyd. Air conditioners continue to remain the mainstay, and it is a journey which will take about 3 or 4 years to pan out, to not only be accepted well by the trade, but also by the consumers.
And are there any supply side risks that you're still facing, and how is the company mitigating these risks?
So far, so good. The only I would say the negative is the cost inflation. Otherwise, from a supply point of view, we are fine.
All right, thanks very much for giving us a sense as to what it's been like. So normalized demand expected by Feb to March, and they're saying that the cost, passing on of the cost will happen over the next couple of quarters. That's the management of Havells for you.